Right, hello, good evening all. Trust we have a lovely day.
Good evening.
Yeah, good evening, sir.
Good evening, sir.
Yes, sir. All right, our class tonight, we are looking at financial statement analysis. Financial statement analysis is a topic most of us can relate with. We understand what is or will be achieved with financial statement analysis. Let me say that this skill, financial analysis, is a skill that must be acquired by all accountants. Financial analysis is a skill that every accountant must acquire, because one way or the other, you are going to find yourself doing financial analysis. Now let's go to the business proper. What is financial statements? Financial statements are statements prepared by companies, usually at the end of the financial year. Financial statements, these are statements prepared by company, usually at the end of the financial year, to show the performance, to show the financial performance, as well as the financial position of the company. Financial statement is prepared to show the company's financial performance for the reporting period and the company financial position at a particular point in time. These financial statements is a report of stewardship. Financial statement is stewardship reporting. What is stewardship reporting? It means the directors of the company are required to report to the owners of the business, explaining the performance of the business to the owner. Because there's diverse of ownership from control, the owners of the business are different from the management or the managers that run the business on a daily basis. The owners of the business are the shareholders. Shareholders are not involved in the day-to-day activities of the business. The shareholders are hired directors who are given the responsibility to manage the affairs of the business. The directors are required by law to report to the owners of the business, explaining the performance of the business to the owners. The means of reporting to the owner is by the preparation of financial statements. The means by which agents report to the principal. Who are the agents now? The agents are the directors. They are acting on behalf of the principal. The principals are the shareholders who have engaged the services of the director. The means by which directors report to the owners of the business is through the preparation of financial statements that is submitted to the owners. The financial statements include the income statement, the statement of financial position, the cash flow statements, and other statements that may be required by law or by accounting standard. The income statements will show the operating performance of the company. The income statement shows the operating performance or operating efficiency of a company. The income statement will show the profit achieved. Profit achieved from operation. So the income statement shows the operating efficiency of a company. The statement of financial position shows the assets and liabilities of a company and how the business is being financed. The cash flow statement shows cash generated and utilized for a particular period. The cash flow will tell us if the company has excess cash or if the company is short of cash. Now, these statements can be subjected to financial analysis. These statements can be subjected to financial analysis. What is financial analysis? What is financial analysis? Financial analysis is the evaluation of the company's financial statements. Financial analysis is the evaluation of a company financial statement so as to determine the company's past performance. So as to determine the company's past performance and also to project the company's future financial prospects. Please look at that word. Financial analysis is carried out for two major reasons. One is to assess the company's past financial performance. Financial analysis is carried out for two main reasons. One, to evaluate the company's past financial performance. Then two, to project the company's future financial prospects. This analysis involves evaluation of the firm financial statements, that is the income statement, analysis of the income statement, analysis of the statement of financial position, and the cash flow statement. To carry out this analysis, to carry out financial analysis, it can take three approaches. Analysis can be carried out under three approaches. One is what we call horizontal analysis. Horizontal analysis is also called trend analysis or line analysis. Horizontal analysis involves comparing financial figure for one accounting year with another accounting year. Comparing trend in financial figure between one accounting year and the next accounting year. For example, we can look at the trend in sales revenue. If you are comparing sales value in year one with sales value in year two, with sales value in year three, with sales value in year four, you are doing horizontal analysis. You have picked a financial item. You now compare this financial item from one period to the other. This is called horizontal analysis. You can pick the profits. Compare profits in year one, 2020, with profit in year 2021, with profit in 2022. What you are doing is called horizontal analysis. You are trying to look at the trend in that particular financial item. So you can carry out trend analysis. Number two is what we call vertical analysis. Vertical analysis. In vertical analysis, a significant item on a financial statement is used or is selected as the base value. In vertical analysis, a significant item in the financial statement is selected as the base value. And all other items within that category, all other items within the category will be compared to the item selected. For example, if you want to carry out vertical analysis of a balance sheet, if you want to carry out vertical analysis of a balance sheet, you can start with the asset. You can start with the assets. In this case, you can select the total asset value. You can select your total asset value. Now, all other asset items will be compared to the total assets. For example, I can do cash assets over total assets multiplied by 100. Look at it. The cash assets divided by the total assets multiplied by 100. What am I trying to measure? I'm trying to measure the percentage of cash in the company's total assets. The percentage of our assets that is represented in cash form. I can use this to measure the liquidity of the company. What proportion of this company's assets is represented in cash form? I can pick inventory assets to total assets. What proportion of the company's total assets is represented by inventory? In this case, you are doing vertical analysis. You are comparing one item in the asset category to the total asset of the company. This is vertical analysis. You can also consider liabilities. Total liabilities. Total liability will be selected as the base value. All other liability items will be compared to total liability. I can look at overdraft liability. Overdraft over total liability multiplied by 100. I want to know the proportion of overdraft in the company's total liability. This is vertical analysis. Also note, vertical analysis is also known as common size analysis. Common size. All right, any questions so far? Any questions so far? All right, let's continue. The number 3 that we can carry out is called, okay, look at this here. This is vertical analysis. Inventory asset to total assets, cash asset to total assets. The number 3, ratio analysis. Financial ratios can be used to carry out financial statement analysis. Financial ratios can be used to carry out financial analysis. Under this ratio, we have, under the financial ratios, we have liquidity ratio, activity ratio, leverage ratio, profitability ratio, and market value ratio. These ratios can be used to carry out financial statement analysis. First, liquidity ratio. Liquidity measures the ability of a company to meet its maturing short-term obligations. Liquidity measures the ability of a company to meet its maturing short-term obligation. Every company must maintain some level of liquidity to meet day-to-day operational expenses. Companies must maintain some level of cash. If you are going to pay salary, monthly salary, you require cash. Other daily expenses will require cash. If you are going to pay interest on loan, the company requires cash. Loan interest is payable annually. That means the company must maintain some level of liquidity. To assess liquidity, we can look at current ratio. Your current ratio is your current assets to your current liability. The extent to which your current assets covers your current liability. The higher the ratio, the better for the company. This ratio measures the ability of a company to meet its current liability out of its current assets. We also have acid test ratio. Your acid test ratio assumes that inventory should not be regarded as cash. Inventory should not be regarded as a liquid asset. And if you are calculating acid test ratio, inventory will be deducted from current assets. We can use this ratio to assess liquidity. Number two, let us look at leverage ratio. Your leverage ratio is also known as financial risk ratio. Please, just 1 minute. Please, just 1 minute. We take it from leverage ratio. Just 1 minute, please. Okay, leverage ratio or financial risk ratio. This ratio measures the ability of a company to meet its long-term maturing obligation. If you observe, we try to bring liquidity ratio and solvency ratio closer. When we explain liquidity ratio, we said liquidity ratio measures the ability of a company to meet its maturing short-term obligation. While solvency ratio, financial risk ratio, leverage ratio measures the ability of a company to meet its long-term financial obligation as they become due. So your solvency ratio focuses on long-term financial capacity of a company. Your leverage ratio is looking at the proportion of debt in a company's capital structure. The leverage ratio is looking at the extent to which a company has borrowed money. If your leverage ratio is high, it's an indication that that company has borrowed excessively. And that could put the life of the business at risk. Where the leverage ratio is high, it's an indication that the company has obtained more debt finance. The financial risk of the company is very high. And that could put the life of the business at a risk. Under the leverage ratio, we have debt ratio, your debt ratio compares the total liability to total assets. It shows the percentage of total funds obtained from creditors. the amount of money the company has borrowed. The lower this ratio, the better for the company. Leverage ratio, sorry, debt ratio is calculated as total liabilities divided by total assets. If this ratio is rising, it's an indication that liabilities are rising. And the company needs to watch it. Once liability exceeds assets, that means that company has destroyed capital, has destroyed wealth. Shareholders' wealth will be at risk. We can also look at debt to equity ratio. The debt to equity ratio is our gearing ratio. The extent of debt in the company's capital structure, calculated as long-term debt divided by equity funds. We also have the interest cover ratio. The interest cover ratio computed as earnings before interest and tax divided by the interest expense. The interest cover ratio shows the number of times the operating profit covers interest expense. The higher the ratio, the better for the company. Then we have the cash coverage ratio. The cash coverage ratio, calculated as earnings before interest, tax, and depreciation. It simply means that depreciation is a non-cash item, and this should be added back to our operating profits. That if you are trying to measure cash coverage, it is better to look at, if you are trying to measure the risk, financial risk, it's better to look at the cash coverage rather than the interest coverage ratio. Because when you are going to pay your interest, you are not going to pay using operating profits. You are going to pay using cash. So your cash coverage ratio is computed as earnings before interest, taxation, and depreciation, divided by the interest expense. All right. We have explained liquidity. We have explained solvency ratio, that is the leverage ratio. Number 3 is profitability ratio. Profitability is a good indication of, it's an indication of sound financial health. Profitability is an indication of sound financial health. If you pick a company financial statement and you are trying to evaluate the performance of the company, the first thing your mind will go to is to check the company's profitability level. You want to assure yourself, is this company making profits? An average investor, the first thing an average investor will ask is about the profitability level of a company before investing in that company. So profitability is an indication of sound financial health and how effectively the company is being managed. Under this ratio, we have the gross profit margin. The gross profit margin is the percentage of gross profits to sales value. We also have the profit margin. You can look at the net profit margin. This ratio indicates the profitability generated from revenue. The profit margin is an important measure of operating performance. There's no way you want to compute, you want to assess a company's performance without looking at the profitability ratio. Profit margin is calculated as profit after tax divided by the sales value. Number 2, we have return on investment. This can also be used to evaluate the performance of a company. Your return on investment is calculated as your operating profit divided by total investment or total capital employed. You can also look at return on total assets. That is the extent to which the asset is used to generate profits. The proportion of net profit expressed by the total assets. We also have return on equity. I'll come back to this. Return on equity. Look at it here. Return on common equity measures the rate of return earned on common stockholder investment, shareholders investment. Return on equity is calculated as profit after tax divided by total shareholders' funds. So you can use this ratio to assess the company's performance. Then we have market value ratio, also known as the investors ratio. Please note, all business decisions should be considered from the viewpoint of the owners. All business decisions should be considered from the perspective of the owners of the business. That is, you must always ask yourself, what is the impact of this decision on the wealth of the shareholders? Under market value ratio or investors ratio, we have the price earning ratio. The price earning ratio measures, I'm trying to shift this. Yeah, price earning ratio. Oh, so let me start with earnings per share. Earnings per share indicates the amount of earnings attributable to each ordinary shares in issue. Earnings per share indicates the amount of earnings that is attributable to each ordinary shares in issue. This is calculated as profit after tax minus preference dividends divided by number of ordinary shares in issue. It is usually calculated in kobo. Number 2, we have the price earning ratio. The price earning ratio is computed as the market price of the share divided by the earnings per share. This ratio can be used to make investment decisions. This ratio can provide guidance on investment decisions. Where your price earning ratio is high, where the price earning ratio is high, is an indication that the investing public consider the company shares in favorable light. A high price earning ratio implies that the company is likely to generate higher earnings at future periods. While a low price earning ratio is an indication that the company is not likely to generate higher earnings at future periods. Let's continue. Number 3, earnings yield. Earnings yield. Earnings yield is a measure of potential return on shareholders' investments. Earnings yield is a measure of potential return on shareholders' investments. Calculated as earnings per share divided by market price per share multiplied by 100. Next, dividend per share. This ratio measures amount of gross dividends attributable to each ordinary share in issue. That is earnings per share. calculated as the gross, dividend per share, calculated as the gross dividend divided by number of ordinary shares outstanding. Multiply by 100. Next, dividend payout ratio. The dividend payout ratio is the proportion of company's profit that is paid as dividend to shareholder. Dividend payout ratio is the percentage of the company's profit that is paid as dividends. Continue. Next discussion, number 6, dividends. Okay, sorry, before I go there, dividend payout ratio is calculated as dividend per share divided by earnings per share multiplied by 100. Dividend payout ratio is calculated as earnings per share, so dividend per share divided by earnings per share multiplied by 100. Our dividend yield. Dividend yield is a measure of actual return on shareholders' investment. Dividend yield is a measure of potential return. Measure of actual return on shareholders' investment. This is calculated in percentage. Then lastly, dividend yield is calculated as dividend per share over market price per share multiplied by 100. Our dividend cover ratio. Dividend cover ratio is the number of times the company's attributable profits covers dividend payments. The number of times the company's attributable profit covers dividend payment. Your dividend cover is calculated as this ratio can be used to determine investors' ratio. We can use this ratio to measure the extent to which the company I think we are done with the explanation. Yeah, dividend cover computed as earnings per share divided by dividend per share. Please don't multiply by 100. Your dividend cover is the number of times the company's profits covers dividend payments. Next discussion, DuPont's analysis. What is DuPont analysis? DuPont analysis or more ratio to explain a particular ratio. When you say DuPont analysis or DuPont model, this is the use of, or it involves the use of two or more ratios to explain a particular ratio. This is DuPont model. The DuPont analysis was developed in the 1920s to explain reason for the value of equity or change in the value of return of equity. DuPont model is a model used to explain the reason for change in the value of return on equity. Remember, the equity holders are the owners of the business. According to the DuPont analysis, three ratios can be used to explain change in the value of return on equity. Remember that equity shareholders are the owners of the business. So DuPont model is trying to look at the reason for change in the value of return on equity. DuPont analysis says that Three ratios can be used to explain change in the return on the value of equity. We have, for return on equity, using DuPont identity, return on equity is equal to profit margin multiplied by total asset turnover multiplied by financial risk. Using the DuPont identity, return on equity is calculated as one, profit margin multiplied by return on total assets multiplied by financial risk. This means that return on equity is affected by operating profit margin, asset turnover, and financial leverage. Just 1 minute, I'm trying to move this up. With DuPont analysis, to increase return on equity, the company will look at the profit margin, asset turnover, and financial leverage. Our profit margin shows operating efficiency. So if you are trying to increase return on equity to shareholders, then you need to improve your operating efficiency. Then you can make more profits. Number two is asset turnover. If you are trying to increase return on equity, then the company needs to improve on its asset turnover. Asset turnover is a measure of asset utilization efficiency, the extent to which a company can use its assets to generate profits. We come to the end of that explanation. Please watch out. November diet last year, examiner texted DuPont identity. The examiner can repeat DuPont identity where two or more ratio is used to explain a particular ratio, or are used to explain a particular ratio. That is the concept of That is the concept of DuPont identity. Any question, please? Any question, please? All right. So, in summary, if you are required to carry out financial analysis, this may involve horizontal analysis, vertical analysis, and ratio analysis. Any question, please? No question. All right, let's start with a small question. Look at question 6, please. Yeah, question number 6 of the material shared. Let us review question number 6. Let us review question 6. The question says, question 6, the following financial information is available for Warri PLC. The following financial information is available for Warri PLC. We have 2014 to 2017. You are giving the equity earnings. Your equity earnings is the profit after tax. The profit after tax is the earnings attributable to equity shareholder. You have the number of ordinary shares given. You have the price per share. You have dividend per share. Next, assume that share prices are as the last day of each year. Requirement A. Calculate Warri PLC earnings per share, dividend yield, dividend cover, and price earning ratio. Explain the meaning of each of these terms and the limitation they may have. 40 marks. This question is very direct. The examiner says, calculate earnings per share, dividend yield, dividend cover, and price earning ratio. So we can move to the whiteboard. Let us move to the whiteboard. Let us address question 1 or questions requirement A. Okay, I'll open my whiteboard. Let's share the whiteboard. All right, please confirm you can see my whiteboard. Also, get your calculator ready. Just 1 minute, I'm trying to enable my pad. Requirement A. Requirement A. We have to calculate some ratios. First, take the year out, create a table. We have the year, 2014, (2015), 2016, and 2017. We are giving the equity earnings. Please note your equity earnings is your profit after tax. Can I have this figure, please?
$200 million.
200 million.
225 million.
225 million.
205 million.
205 million.
230 million.
They have 230 million. Number of shares, number of ordinary shares. Can we have this figure too?
2,000 million.
2,000 M.
2,100 million. 100.
2,100.
Again, 2,100.
Then
1,900.
We are giving price per share.
220.
Yeah, in cover.
Yes. 220.
20 cover.
305. 305. 290. 290.
290.
260.
260 cover. Then we are giving dividend per share.
5.
Per share.
5 cover.
5 cover.
7 cover.
7 cover.
8 cover and 9 cover.
8 cover. 9 cover. We have to calculate one EPS. What is the formula for EPS? It becomes.
It's a less preferential. Dividend no preferential.
In this case, we don't have preference share now. Equity earnings divided by ordinary shares. Please compute equity earnings divided by ordinary number of ordinary shares multiplied by 100. Yes, please. Equity earnings divided by number of ordinary shares multiplied by 100. What do you have, please? Let us calculate earnings per share.
10%.
This is not in percentage. By multiplying by 100, you are going to get kobo.
Okay. 1
So we
kobo.
have 10 kobo.
Year 2, 10 nairas. 11 kobo.
10 kobo.
Year 2, 11 kobo.
10.7 kobo.
Okay.
Year 3, equity and divided by number of ordinary shares. Year 3 should be 9.8 kobo. That is 205 divided by 2,100. Multiply by 100.
$10 kobo.
9.8 kobo. Then 2017, what do you have? That should be like and the cost is 12.1 kobo, if I'm not mistaken. Please, you can reconfirm. 230 divided by 1,900. Multiply by 100.
Confirm 12.4.
You have gotten the earnings per share. Next, dividends yield. Dividends yield. Please, what is the formula for dividends yield? Please, what is the meaning of dividends yield? And how do we compute dividends yield? Dividends yield is a measure of actual return on investment. Dividend yield is a measure of actual return on investment. This is calculated as dividend per share divided by your dividend per share divided by market price per
Market
share.
price per share.
Multiply by 100. We are giving dividend per share for 2014, 5 kobo. Price per share 2014, 220 kobo. Please divide 5 divided by 220. Multiply by 100. What do you have?
When 3 kobo.
That gives us 2.3. Please, if you multiply by 100, you are computing in percentage. Let me look for this thing, Jerry. Just Sorry, my pen percent. Next, dividend yield for 2015. 7 divided by 305 multiplied by 100. What do you have, please?
2.3%.
Move to the year 2016. 8 divided by 290. Multiply by 100. Is that correct, please?
Yes, sir.
2017. 9 divided by 260. What do you have, please?
3.5%.
0.5. You have computed the dividend yield. Next, number 3, what do we have? Dividend cover. Dividend cover ratio. That is the number of times the company's profit cover dividend payments. Is calculated in times. Number of times the company's distributable profit covers dividend payments, computed as earnings per share divided by dividend per share. Our earnings per share is $10. Dividend per share is 5 kobo. So this will give me 2. This is 2. Year 2015. Earnings per share 10.7 divided by dividend per share 7. Please, what do you have? That should be like 1.5. 2017. Earnings per share 9.8. Dividend per share 8. 9.8 divided by 8. What do you have?
$1.23.
1.2. Just addition. 1.2. Then the last one.
1.3.
1.3. Earnings per share 12.1 divided by dividend per share 9. That will give you 1.3. Lastly, price earning ratio. Price earning ratio. That is market price per share divided by earnings per share. Market price per share for 2014, 200 kobo. Earnings per share for 2014, 10 kobo. This will give me 22 times. Next, market price per share, 307, divided by earnings per share, 10.7. What do you have, please?
$28.5.
28.5, sorry. 28.5 times. Next, market price per share, 290, divided by earnings per share, 9.8.
29.6.
29.6. Then lastly, 21.5, I guess. Market price per share, 260 divided by earnings per share, 12.1. What do you have? Please check that out. 260 divided by 12.1. What do you have?
21.5.
We are done with the computation. The question says calculate earnings per share, dividends yield, dividends cover, and the price earning ratio. And now say explaining the meaning and the limitation of each of these concepts. So, what is the meaning of earnings per share? What is the limitation of earnings per share? The line is open. Let's discuss. What do you understand by earnings per share? Let us open our speaker. Let's discuss these 4 items.
Guys, the share of profit attributable to every shareholder. That is ordinary shares each ordinary
Okay.
share belonging to ordinary shareholders. So the
Okay.
limitation will be something like the temptation by managers of the company to want to split stock so that they can boost their earnings per share. They can
Per
manipulate
share.
the EPS so that they can
Okay, yeah.
it's an impression that they are doing, for instance, like stock buyback or maybe splitting stock or additional shares, depending on exactly what they are aiming to do, whether to
Right,
increase or to decrease EPS.
yeah, what I wanted to get out is earnings per share is that one major limitation is a rise in earnings per share may not necessarily mean that the company is doing well. A rise in your earnings per share does not necessarily mean that that company is doing well, because the accounting profit is subject to distortion and manipulation. You can manipulate your profit to increase your earnings per share. So it's very possible for the company management to manipulate the profits, and that will show increase in earnings per share. Also, where there is share buyback, earnings per share is likely to increase. Number 2, dividend yield. What is dividend yield? What is the limitation, or what are the limitations of dividend yield? Yes. Dividend yield is a measure of actual return on investment. Dividend yield is a measure of actual return on investment. It's calculated as your dividend per share divided by market price per share multiplied by 100. One limitation with this measure is that it is not only dividends that represent return to shareholders. Shareholders are still entitled to capital gain on share owns. So please note, so when you get to return, dividend is not only the return to shareholder. We also have capital appreciation. Number 3, dividend cover ratio. What is dividend cover ratio? Our dividend cover is the number of times the company's distributable profits covers dividend payments. Our dividend cover is calculated as earnings per share divided by dividend per share. Number of times earnings cover dividend payment. Limitation with this ratio. At times, interpretation might be conflicting. At times, interpreting the movement in this ratio might be conflicting. Interpreting the trend in this ratio might be conflicting. For example, oh, the line went off. The line went off temporarily. So if you are trying to interpret the movement of dividend yield, at times if the figure is rising, it could mean that you have more profits to meet dividend payments. At times it could mean that you are paying more, you are paying more dividends to shareholders. Most of your profit are paid to dividend as shareholders. That could give conflicting information. And lastly, price earning ratio. The price earning ratio is one of the most important measures of share performance. It relates the value of shares to the earnings generated from the share. It relates the value of shares to the earnings generated from the shares. A higher price earning ratio where there's growth in your price earning ratio, it's an indication that the company is likely to generate higher returns at future periods. and a fall in price earning ratio could be an indication that the firm is not likely to generate sufficient cash at future period. One limitation with price earning ratio is that stock market price, there are several factors that determine the market price of a product. There are several factors that determine share price, which is not within the control of the company. These other factors are not within the control of the investor. So if you are looking at price earning ratio, you need to be careful. Where there's rise in share price, we have explained this limitation. We have explained price earning ratio. Let's look at requirement B. Requirement B says I want to take it all small. Explain why the changes that occur in the figure calculated in A above the past 4 years might have happened. Yes, we have to explain why changes in these figures. Let's go back to the figure. Okay. We are required to explain why you have changes in this earnings per share. In 2016, 10 kobo. 2014, 10 kobo. 2015, 10.7. So we want to look at the trend. Look at earnings per share. Earnings per share is just growing. So if you are to answer this B part, you are going to look at the trend between 2014 and 2015. Let's look at this. Look at the trend. To be able to give explanation to this, via notes. Let me share on that whiteboard. If you are to answer this, you are going to do like this. You are going to have trend between (2014) where is this? 2014 and 2015. You are going to write on this. Then we talk about trend between 2015 and 2016. Then we have trend between 2016 and 2017. We are going to look at these three headings to explain that requirement C. If you go back to that question or to solution 1.
I'm still seeing the old one.
Oh, you can't see my board?
No, no.
Just 1 minute. Why? I know. Is an A. Okay. You are supposed to explain under these three headings. You are going to look at trend between 2014 and 2015. You are going to compare those figures. If you look at this. Gosmo. Yeah, what you are doing is actually horizontal analysis. That's what you are going to do here now. Please check between 2014 and 2015. What has happened to equity earnings?
It has increased.
You can see there's growth in equity earnings. What is the percentage increase in equity earnings?
Five 5.5%.
12.5% growth. You keep it. Now look at number of ordinary shares. Between 2014 and 2015, number of ordinary shares has grown by how many percentage?
5%.
5%.
Yes.
Okay. You can now explain that between 2014 and 2015, equity earnings increased by 12.5%. At the same time, number of ordinary shares increased by 5%. At the same time, number of ordinary shares also increased by 5%, also increased. You can put it back at 5%. However, the increase in equity earnings is greater than the increase in number of ordinary shares. This resulted in growth in earnings per share between 2014 and 2015. If I'm trading 2014 and 2015, I will now look at equity earnings. Between 2015 and 2014, equity earnings increased by 12.5%. And number of ordinary shares increased by 5%. This resulted in increase in earnings per share. Our dividend yield remain unchanged. This occurs as a result of increase in dividend per share, as well as increase in share price. Then you are going to look at the interest cover ratio. Sorry, dividend cover ratio. Dividend cover ratio between 2014 and 2015 shows a reduction. A dividend cover ratio shows a reduction in this ratio. An indication that more of the companies dividends, more of the company's profit is paid as dividends. More of the company's profit is paid as dividends. Which may affect the company's future earnings capacity. Where a company is paying more of its profit as dividends, it could affect the company's future earnings capacity. Then lastly, our dividends, our price earning ratio. Our price earning ratio shows number of times the market price can cover the earnings. Between 2014 and 2015, there is significant growth in this ratio. A growth in this ratio is an indication that the company is likely to generate higher earnings at future periods. The growth in this ratio is due to increase in the company share price. We have trend 2014 and 2015. You can look at 2015 and 2016. You can trend. We're not going to be comparing the figures, explaining what could have been the reason for change in this value. Look at 2016 and 2015. What has happened to equity earnings? The profit of the company has fallen. In 2016, you observe that we have reduction in equity earnings. The equity earnings has fallen. This could be as a result of paying more dividend out and retaining less for investment purposes. You observe that there's fall in share price between 2015 and 2016. Sorry, between 2015 and 2016, earnings per share falls. This is due to fall in equity earnings, profit after tax. We can go on and on with the explanation, but the figures required for trending is available. Just to explain this, all right. I don't want to see if I can get that trend. I'll just share. Let me look at any question, please. Any question, please? If there's no question, we might have to stop here tonight. All right. We stop the class here tonight. May God give us a better understanding. Let us have a blessed evening. All right, good night, and let's remain blessed.
Good night, sir.
Thank you, sir.